Here is your expanded script, approximately 2,420 words, approximately 15.5 to 16 minutes when spoken at a natural podcast pace. Glad you're joining us. Welcome to Modern Investing Techniques, Episode 5, recorded on March 26, 2026. I'm Patrick, coming to you from Vancouver, British Columbia. Whether you're listening on your morning commute across the prairies, during your lunch break in Toronto, or while winding down in Vancouver, I'm glad you carved out time to level up your investing process. Today, we're going to dissect two powerful sentiment signals that are colliding right now: heavy short selling in a major fintech name and fresh positive regulatory clarity on XRP. And we'll turn those signals into practical, repeatable frameworks you can actually use in your own portfolio. Before we dive in, the standard but important disclaimer: everything we discuss on this show is strictly for educational and entertainment purposes. The practice investment of the day is a simulated trade using no real capital whatsoever. I am not a licensed financial advisor. This is not financial advice, and none of what we cover constitutes a recommendation to buy or sell any security. Markets involve real risk of loss. Always do your own research and consult a qualified financial advisor before putting any of your hard-earned money to work. Past performance does not predict future results. North American markets showed quiet resilience today despite lingering global uncertainty. The TSX Composite was the clear outperformer, closing at 32,383, up a solid 1.4% on the day. The NASDAQ Composite finished at 21,930, posting a respectable 0.8% gain, while the S&P 500 ended the session at 6,592, up 0.5%. On the surface, it looks like a fairly ordinary green day, but beneath that calm surface, we're seeing meaningful divergence in sentiment, especially around high short interest names and crypto-related assets. One factor that continues to loom over the entire risk complex is the ongoing geopolitical tension between Israel and Iran. Any escalation in the Middle East tends to send immediate ripples through energy prices, defense stocks, and overall risk appetite. For Canadian investors, this matters more than most people realize because so many TSX-listed companies, particularly in energy, materials, and industrials, have direct or indirect commodity exposure. When oil jumps or gold gets bid as a safe haven, it can mask weakness elsewhere. Retail investors should stay alert to how risk assets react to any headline that either de-escalates or worsens the situation. Even small shifts in probability can move entire sectors within hours. On the domestic calendar, Canadian investors should also keep the Bank of Canada's upcoming December 9th rate decision and the October 28th monetary policy report on their radar. While Todd A's market action was constructive, the combination of sticky inflation, geopolitical risk, and selective sector rotation is creating exactly the kind of environment where short squeezes and mean reversion opportunities tend to appear. That brings us directly into today's strategy spotlight. We're seeing an aggressive spike in short interest against SoFi Technologies, and that kind of concentrated bearish positioning deserves careful analysis rather than reflexive dismissal. The core idea behind this strategy is to treat elevated short interest not as automatic confirmation that the company is doomed, but as a potential setup for either a violent short squeeze or at least a meaningful mean reversion bounce, provided the underlying fundamentals are actually improving and contradicting the bearish narrative. In the current environment of elevated geopolitical uncertainty and choppy sector rotation, high short interest in fintech names like SoFi deserves extra scrutiny. Macro shocks or even mildly positive catalysts can force rapid short covering, especially when a stock has already been punished with a nearly 50% drawdown from its highs. The mechanics are straightforward. When too many investors crowd into the short side, any shift in sentiment can create a feedback loop where shorts are forced to buy back shares, driving the price higher and triggering even more covering. To put this into practice, start by pulling short interest data directly from your brokerage platform or use free resources like Yahoo Finance, TradingView, or Ortex. Once you have the numbers, cross-reference them against hard business metrics: revenue growth trends, cash position, customer acquisition costs, net interest margin expansion, and valuation multiples. I personally like to set alerts when short interest climbs above 15 to 20% of the float, because that's when the setup becomes statistically interesting. Then look for clear divergence. Is the short thesis still valid given the latest quarterly results, or has the business quietly improved while the narrative stayed stuck in the past? Historically, this framework has tended to work best in high growth but misunderstood sectors after the stock has already suffered a sharp 40 to 50% sell-off from its peak. The psychological pressure on shorts becomes enormous at those levels. That said, this is not a risk-free tactic. Shorts can be right, and in some cases, forced liquidations or margin calls can drive the price even lower before any rebound materializes. That's why position sizing is non-negotiable. I never risk more than 1 to 2% of the total portfolio on any single idea. Always define your stop loss below a recent swing low or a clear technical level, and respect it without emotion. Canadian investors can absolutely run this screen inside both their TFSA and RRSP accounts, but you must track your adjusted cost base carefully if you plan to trade more frequently to stay on the right side of CRA rules. This exact T framework is being applied right now in our practice investment of the day. Our simulated weekly hold is SoFi Technologies on the NASDAQ. This is a purely educational, contrarian, mean reversion play based on elevated short interest running into a digital banking franchise that continues to show fundamental improvement. Again, this is a simulated trade for learning purposes only. No real money is being risked. The primary catalyst today is the sharp increase in short selling that was reported, coming after the stock has already declined nearly 50% from its all-time highs. That creates a fertile setup for covering if any positive catalyst emerges in the coming days. Technically, the stock remains in a clear downtrend on the daily chart, but we are watching closely for signs of stabilization near recent support levels. Any bounce would ideally be confirmed by expanding volume. On the risk side, we recognize that fresh geopolitical headlines out of the Middle East could trigger a broad risk-off move that drags fintech names lower regardless of company-specific progress. Our exit plan is straightforward. We would cut the position if price breaks and closes below the recent swing low, which would represent a maximum acceptable loss of approximately 8% on the simulated position. Our target range for this weekly hold is between 4% and 9% upside by Friday's close. Overall confidence level on this idea is medium. We have two solid factors aligned: high short interest plus a deep prior drawdown, but they are partially offset by ongoing macro uncertainty from the Israel-Iran situation. The deeper lesson here is learning to treat short interest as a sentiment indicator rather than a death sentence. You want to develop the discipline to wait for clear divergence between the prevailing narrative and the actual business fundamentals. Proper position sizing and ironclad adherence to stop-loss levels are what separate reactive traders from process-driven investors, even if his particular simulated trade ends up losing, the analytical framework you learn from it will serve you on many future setups. Closely related to sentiment and short interest is the critical but often overlooked topic of liquidity and execution, something that can quietly destroy small edges if you're not deliberate. Imagine you placed a market order for a mid-cap fintech stock last week right after a wave of negative headlines hit. Your order filled at $12.45. But when you went back and checked the time and sales tape, you realized the stock never actually traded at that exact price in a clean print. The bid-ask spread had blown out from just 3 cents to 28 cents in the first 45 seconds after the news dropped. Your market order swept through multiple levels on the offer, costing you an invisible 2.1% in slippage before the position even had a chance to work. Liquidity is never constant. During normal trading hours, the average bid-ask spread on liquid Canadian and U.S. equities might sit comfortably between 4 and 8 basis points. But geopolitical headlines, surprise short-selling pressure, or even just an earnings miss can push that spread to 25 to 60 basis points within minutes. Professional traders always check the level 2 order book, or at minimum the percentage spread, before hitting the buy button on anything outside the top 50 most liquid names. The smartest retail investors I know never use pure market orders on stocks with average daily volume under 1 million shares. Instead, they use limit orders placed intelligently between the current bid and ask, or they simply wait for the first 15 minutes of trading, when spreads are typically at their widest, to pass before entering. The biggest misconception among newer investors is believing that the last traded price you see on your screen is guaranteed to be the price you will actually receive. In reality, you should always check the current bid-ask spread and the stock's average daily volume before entering any new position. Developing this single habit prevents more small, unnecessary losses than almost any other retail mistake I see. Speaking of staying ahead of traditional Wall Street coverage, let's move into our tools and techniques segment and talk about practical ways to get exposure to some of the most exciting emerging themes right now. For investors interested in figure AI and the rapidly advancing field of humanoid robotics, one of the cleanest ways to participate is through thematic ETFs that bundle multiple players in the space. You can supplement that core exposure with powerful AI-driven research tools such as Perplexity or custom GPT-based screeners that help you track patent filings, partnership announcements, and hiring trends in real time. Canadian investors should ideally hold these higher volatility growth names inside their TFSA or RRSP to defer taxes and let compounding work without unnecessary drag. You can access these thematic ETFs easily through platforms like Wealthsimple, Questrade, or Interactive Brokers. As always, I have no financial relationship with any of these platforms and receive no compensation for mentioning them. The latest positive regulatory development from the Securities and Exchange Commission regarding XRP has created an immediate need for better real-time monitoring tools. This is where on-chain analytics platforms like Dune Analytics or Nansen become extremely valuable. Both offer free tiers that are more than sufficient for most retail investors. You can track wallet activity, large exchange flows, and whale movements in the hours and days following major regulatory news. Combine those on-chain signals with simple TradingView alerts set on the XRP-USD pair for technical confirmation. This multi-layered approach gives regular investors a genuine edge because you're watching actual capital movement instead of simply reacting to headlines like everyone else. Before we wrap up, here are a few quick hits worth keeping on your radar. Aviation law experts have noted that passengers injured in the fatal LaGuardia collision involving Air Canada have multiple legal avenues available and could potentially sue for up to nearly $300,000 per claimant. For investors, this story serves as a reminder to carefully monitor liability exposure and insurance coverage when holding airline names inside diversified portfolios. Canadian investors who own AC in their TFSA or RRSP should watch for any material impact on the company's balance sheet in the coming quarters. On the REIT front, Morgan Stanley upgraded Equity Residential while simultaneously downgrading Avalon Bay Communities. They cited greater market resilience for the upgrade on Equity Residential, while the downgrade on Avalon Bay was driven by concerns around the earnings outlook. This kind of divergence within the multifamily sector creates an excellent opportunity to compare balance sheets, occupancy trends, and debt maturities between the two names using free stock screeners. After doing that homework, some investors may choose to explore relative value trades in either taxable or registered accounts. In Latin America, Colombian President Gustavo Petro's approval rating has risen to its highest level since 2024. This development could meaningfully improve prospects for his political allies ahead of the May presidential election. Resource investors with exposure to Colombian oil or mining assets should monitor how greater political stability in the country might affect permitting, taxation, and overall operating conditions in the region. Finally, a consumer safety note. Certain milk products under the Farmers, Natrel, and K-Bomb brands are being recalled due to the potential presence of glass fragments. While this is primarily a consumer story, investors in Canadian consumer staples or food processing companies should recognize that repeated recall incidents can eventually affect brand value, customer trust, and insurance costs over the long term. Our Simul aided portfolio currently sits with a modest positive return across the handful of weekly holds we have tracked so far. The win rate is sitting around 55% with an average return per trade of roughly 3.2%. Our AI-driven analysis continues to learn from patterns in short interest divergence and is adjusting screening parameters each week. This remains a learning journey, not a track record to follow blindly. Before we sign off, keep a close eye on how any further developments between Israel and Iran affect energy and defense names on the TSX tomorrow. That's it for today's episode of Modern Investing Techniques. If you found this useful, please share it with a fellow investor who's trying to move beyond simple index investing, and subscribe wherever you get your podcasts. You can find the full list of tools, platforms, and resources we discussed on the resources page. We'll be back tomorrow with fresh market intelligence. Until then, keep learning, keep refining your process, and keep investing with discipline. This version expands every major section to 6 to 8 sentences where appropriate, adds meaningful context and my personal take, creates natural transitions, and maintains the original story order and content without introducing new stories. It should now comfortably fill the 13 to 17 minute target. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.